Preparation account related to the purchase and sale of a business involves recording and documenting financial transactions in order to accurately reflect the acquisition and disposition of liabilities and also disposition of equity. Let me now provide a general outline of steps that is involved in preparing accounts for both the purchase and sale of a business. Under purchase of business, the first thing that is needed to do is the due diligence. In due diligence now, before the purchase, there has to be a crucial need to conduct true due diligence in order to gather all relevant financial information, all relevant contracts, and to record from the sellers. The second one is that asset valuation. At this point, we must determine the fair market value of the assets and the liabilities that is being acquired. What I mean by fair market value of the asset is just the price at which a property or service would sell between a willing buyer and a willing seller in an open and unrestricted market, where the two parties, that is the buyer and seller, have a reasonable knowledge of the relevant facts. And in addition, common methods for asset valuation include income-based, market-based, and asset-based approaches. The third one is the purchase price allocation. When we are talking of purchase price allocation, there is a need to allocate the purchase price of the specific assets and liabilities that is acquired. And this is important for accounting and tax purposes. The fourth one is the goodwill calculation. In goodwill calculation, there is a need to calculate any kind of goodwill that is arising from the purchase. That is goodwill, it represents the intangible value of the acquired business, and it is the excess of the purchase price over the fair market value of the net assets acquired. Another one is the contingent consideration. If the purchase price includes contingent payments, what I mean by contingent payments is the earnout, and there is a need to account for them as a liability and to adjust them as they are realized. The sixth one, which is another one, is the amortization or depreciation. If applicable, there is a need to amortize or depreciate the acquired assets over their respective useful lives. Goodwill is typically tested for impairment annually. Another one, which is the seventh point, is the financial statement. When we are talking of financial statements, there is a need to prepare pro forma financial statements. The pro forma financial statement has to incorporate the acquired business's results into the buyer's financials. And this may include income statements. It can also include balance sheets and cash flow statements. The eighth point is the tax considerations. In tax considerations, there is a need to work with tax professionals in order to ensure proper tax treatment of the acquisition, including any deductions, including credits or deferrals that is available.